Um, can anyone hear me? Sylvia?
Hello.
Yeah, hello. Can you hear me?
Okay. You can hear me. Hello.
It has like a echo. I don't know what the issue is.
Mute. Mute your computer.
Hello?
Hello.
Yeah, I can't mute because I can't hear myself if I mute.
Mimi ndio nasikia echo on my end. I don't know why.
Try right now.
Hata sahi.
Okay.
Hii link yenye iko hapa ni bani?
Okay, I'll
Computer ama si kwa Zoom. See the sound system.
Peter, can you hear that echo? Mute the speaker for the computer.
I've already done that.
It's already muted, but the echo is still on.
Can you hear me now?
Nikijoin na comment audio ndio.
Hello.
Sam. I can hear you. The problem is that
Testing. 1, 2, 3. Testing.
Hello?
Can you hear me?
Yeah, I can hear you. What about you?
Yeah, so I'm using my phone to speak and
Okay.
then the computer to
Ah,
yeah.
okay. So, hebu ngoja kwanza ni connect. Tumebidi to move locations.
Oh, okay.
Mbona niko uko like naona tu saa mwawili.
Si ndio nasema I'm using my phone for the audio. But let me test if
Because he's using his phone and his computer. And you're
Oh, he's using both. Mbona hii ya STL hapa iko dark hata kuna logo na kwa nini?
Can you hear me?
Unatumia two devices, right?
Right now I'm using one. Can you hear me?
Nashindwa mbona hii ni ya STL, no logo, nothing. Hata my
So
face
ni profile
image.
picture, I think.
Kwani natumia account gani? Jesus.
So I'll just log in with this one so that I can see my presentation and hear myself. Hello?
Yes?
Oh, okay, so it's good. We're just checking. Hey, your mic test. Anyway.
Unajoin ndio unaanza?
Yeah, I'm waiting for you guys to
to be ready to settle.
Yeah.
So utaanza, you take it from the start mpaka prime mama?
I can, but see, people are expecting you, so you'll have to start speaking fast.
Yeah, I'll start speaking fast, of course.
So I start the webinar.
No, every chill.
Okay.
What? So what do you want? Exactly.
I want you to sit on this meter.
So ikitu God. Normal view. Jeez, how do you view this thing without seeing this? Where? Sam.
Ask him to start. When he goes up and goes down.
Samson.
Nianze.
Uko up? Oh, okay.
Yeah.
Just a moment, just a sec.
Okay, so. But my voice is clear, yeah?
Yeah, it's very.
Hello?
Okay, Sam. Anzisha. Okay, Sam.
Can I share the screen from my end?
I think you can.
Okay, because I
want to start.
You
So-
have already.
So could you need the screen so that I'll show it for my end?
I think the webinar has begun, Sam.
Yeah, I'm saying,
Mm.
can I share the slides from my end because there's something?
Oh, yeah.
Okay, so. Yeah, I'm waiting for you to stop sharing so that I can.
Oh, okay.
Yeah. Okay, I'm good on my end.
Okay, hello everyone. Welcome to another webinar by STL. And first of all, apologies for the delay, having technical issues. So welcome to yet another webinar. Today we'll be doing this webinar with my colleague, Samson Mzera, and it's all gonna be about order flow. And I think you have control of the presentation slides, so you will basically be flipping through it. So before we continue, as usual, it's very, very important for all of you to understand that any information that you're getting from this presentation is for educational purposes only, and that trading financial instruments, derivatives carries a degree of risk. So I'm gonna give you guys time to go through this. Couple of seconds. And yep. So what is order flow trading? It's very important to, first of all, understand the concept of order flow even before you begin looking at other methods of analysis. And order flow basically is also known as tape reading. And it is a technique that has basically been with us for quite a long period of time. Many market participants, even in the past, very successful ones, Jesse Livermore, Wyckoff, they all used order flow, and those days they used to call it tape reading. So it's simply a technique that you use to analyze price and volume of a particular asset. So you are getting extra information, not simply by just looking at the chart, but extra information as to price and volume. And the other thing we'll talk about is microstructure analysis, which will focus on how the exchanges are set up when you're trading a particular currency, OTC, over the counter, that is, how are the exchanges set up, who are the participants. It's important to know who are the participants and who are the individuals on the other side of the trade, of any trade that you want to take, whether it's a buy or a sell. So it's important to understand how the market structure is basically set up. The other thing, stop and option hunting. So this is simply a trading style. And we use tape reading, that is the study of volume and price, to understand at what particular area will stops be triggered, and to understand which side of the support or resistance stop hunting will tend to occur or happen. So that is basically simply what we'll be covering here. It's very important to understand, guys, that order flow is not a strategy. We're not going to talk a strategy per se. It's a methodology. Very important to understand that. It's a methodology basically in which you use to understand how the market functions, how market participants operate. And what do I mean by that? Basically at a transactional level. So Sam will take it over from here, the primer. Sam, carry on, and then I'll be joining in later.
Okay, thank you, Dennis, for that introduction. So good afternoon, everyone. My name is Sam, and I'll be taking you through the rest of this short presentation. So first off, when we were thinking with Dennis about how to structure it, we were really trying to see how best to include just enough for this introduction, because I believe the webinar is 1 hour, but then there's still a lot to cover. What you're going to cover in this webinar is not really going, it's barely touching the surface of what order flow is. Because as Dennis has said, order flow is a mindset, and it's really a way of looking at the markets. So I'll give an example. When we were doing chemistry back in high school, the first concepts we learned were the structure of an atom, the structure of and molarity. And when you're trying to mix chemicals, you really have to know those basics before you do anything else. So this is the same thing with order flow. What you're really trying to do is understand how price moves. And once you understand how price moves and how it behaves, then from there now you're in a better position to know how to even conduct price action analysis or technical analysis and things like that. So the basis of order flow really is just understanding how price moves. So let's begin with this. Yeah, so yeah, that's the basis, understanding price movement. And what you're going to be looking at first is the basic terminologies around order flow and what we mean by order flow and where do we begin. So the first thing we need to know is an order book. So an order book lists the number of assets being bid or offered at each price point in the market. So when you're doing FX, you might not be able to see an order book, but it's usually there and the broker is able to know if, say, the euro is at $1.2, being sold at $1.2, the broker is able to know how many orders are above 1.2 orders, around $1.2 and below $1.2. So it's really just a recording of various pending orders and how orders are coming into the market. The order book just keeps a record of that, and we'll see how we'll try to construct one as we try and understand how order flow is. So connecting this to order flow, what we are trying to do is understand how prices record themselves and how traders come in and go out. And you can read this from the order book. And if you understand the order book, then now you're basically now trying to understand order flow, understanding how price moves. So the second thing I've mentioned here is it shows the market depth. So simply the market depth is just the level of orders around your bid and around your ask. So the bid and ask is basically the sell and the buy price. So let's have a simple look at a simple order book. So yeah, so this is what we constructed. So it's going to showcase, you're trying to use this to showcase a few points. And then from here, you'll have a more complex structure. And then if you have the opportunity to either log into TradingView or some platform, you can now see the actual order book and how it behaves. So what you're really trying to do again is just to understand how price behaves in the background. Remember, this is information that you're not going to see in the charts, but it's there and you're supposed to know how to reverse engineer this order book so that you're able to now do price action more effectively. And we'll show you how it's going to be more effective, even with your analysis. So basically on your order book, you'll have the bid column, your ask column, and then your prices listed over here. So what you see on your charts, when you open, say, a chart for Euro USD, you'll see the quotes that are currently closest to the quotes that are currently closest to the lowest ask and the highest bid. So if you open a chart, say for this particular market we've created, the buy button will read 1.3 and the sell button will read 1.2. So this is how prices are in the background, what the broker is seeing. So here you have, say, the name of the guys who are placing orders. So trader E, for example, is asking 13 contracts at 1.5, meaning if you say if the price was at 1.5 and you click buy, then it's trader E who is going to sell you these contracts. So this is basically just a simplified version of the order book. And as we go through our journey of understanding price, then you'll see how the dynamics play out. So now let's introduce a buyer to this market. So we know that there are two types of orders in the market. We know there's the pending orders, and then there's the market orders. Pending orders is when you put a buy limit order to buy at a specific price. That usually goes to the order book, and the broker is able to see that on their table or their order book. So let's look at one example. So say we have a trader named G. He comes to the market with 60 contracts and he clicks a buy market order, or he wants to buy market, to buy the market at the best available price. So when he clicks buy, then the order will be directed to the order book. So G will consume all of A's and B's orders. So basically, a contract of 60, an order of 60 contracts will consume A's contracts that is asking, and then B's contracts. And then let's just see how that looks like after this order has been completed. So a trader, say G, who came into the market and bought 60 contracts of whatever asset it was, they'll consume all of A's assets and B's assets on the order book. So you can see how price has behaved and how those orders have been consumed. And basically, one of the questions people usually ask me is, how comes when you go, say, to the NSE and you want to buy an asset, it will take you like 2-3 days to find a buyer and then another 3 days to clear. But in the Forex market, for example, you have this order book where these guys, the dealers, are usually just placing orders so that anytime you click buy, your order is consumed, or there's someone else taking that counterparty order, either be it pending orders or just normal dealers. So as you can see, the difference between this chart and the previous chart, an order of 60 contracts came in, it consumed these 50 contracts, it consumed these 5 contracts, and what you're left with is 5. So it went to this 13 price here and consumed 5 contracts from this 13. And that's how G's order was processed. So from that, you can actually understand how price was changed, because now the new ask price on your chart will be 1.5 and the new bid on your chart will be 1.2. Basically, the 2 buttons you see for buy and sell. Then you get to understand exactly how price has changed, so that now you know what happens when the price shifts. So say from here, say the price has shifted from 1.3 to 1.5. You sort of get the picture of what's happening in the background. So we can try and make some inferences from this to broaden our understanding. So let's go to what we've learned so far. So large orders can consume liquidity on the price changes when large orders consume liquidity on the order book. So as you've seen from the table, trader G with his 50 contracts came in and consumed the 50 contracts that were here, 5 contracts here, and the remaining 5 from this guy. So what you can see is the price actually shifted. That's how the price shifts in the market. So if it's a large enough order, then probably someone who can come, there's maybe a huge hedge fund that can come and just consume everything on this book, and the price will keep on going higher and higher. So from that, you kind of get a feel of how prices behave in an order book, or in the markets rather. So yeah, so that's the first example. And then the second thing we learn is price stops or ceases to change, trend, or move once all the orders are absorbed in the market. So this is another important thing. Remember, these are simple concepts you're constructing from this table, but then when you actually go to the markets and start analyzing trends and charts, and you start knowing how it works in the background, then you're going to have an advantage over someone who's just doing maybe basic price action or technical analysis. So the second inference says price will stop once orders are consumed. So say for trader G, the 60 contracts, price started moving from 1.3 and it stopped at 1.5. So that means that this order block over here actually consumed the remaining orders, and that's when the price stopped. So you can even start thinking and start seeing, okay, when I see a trend and the trend stops moving, then I know there's an order block there that has now finished all the orders that were, say, buy orders in the market, and now that's when price stops. So those are 2 very important inferences, and I want you to keep that in mind even as we go to other instances of this order flow analysis. So I won't be using charts very much at this point, because there's still a lot of concepts under order flow just to understand before you even look at charts. And this is what I usually think should be the basics, or any beginner in trading and in Forex and any markets should first start by understanding exactly how price works. Because this is really the basics of how the market works and how the market operates. So now we go to another instance. So yeah, so the first example, we only assume that there is one trader in the market, trader G, who was buying 60 contracts. So now we can assume assuming trader A had only 30 contracts. If trader G came to the market to buy 60 contracts. Okay, so let's say there were less contracts in the market. Let's say instead of what we had here, which was 50, now they're 30. So you get to see that when trader G comes in with his 60, the order of 60 contracts, it's going to push prices all the way. So this is how the order book is going to look like a few seconds after trader G has placed his order. Now you see that the price has been pushed beyond 1.5. Then you get to see how also, again, how price moves in that order. Let's see, I think I've repeated. Yeah, so now we're able to make more inferences from this instance. So I'm going to be dropping these concepts one by one, and then we might summarize them. And then from there, you're able to build a way of thinking about the markets when you do your price action or when you do any other thing. So the first thing is, from what you've seen here, if a trader comes in, has their contracts, and then they immediately buy, you see that, number one, the spreads changed. Change in spreads is a market. You can conclude that change in spreads is a market phenomena and not the broker trying to collude or do anything like that. It's usually just a market phenomena of how things happen in the market. So spreads tend to increase when there is low liquidity in the market or when there is a lot of demand in one direction, of which that's what you've seen. From the first instance, we've seen that the 60 contracts here had consumed all the orders on the order book, all the contracts on the order book until point E. So now on your chart, you'll see that your spread has increased from a spread of 0.1, which is 1.3 minus 1.2, to a spread of this between 1.5 and 1.2, which is 0.3. So you see how the spread, you can also see how the spread has behaved. And this is something you can actually see in markets, even say over midnight when there's low liquidity, you can actually see the spreads actually increasing and reducing on your chart. Another thing you can see is, say over weekends, when you try and hold a trade over weekend, before the market close, you usually see the ask and the bid widen because there's little liquidity, and that means now orders are able to influence. You can able to see that effect of spreads increasing and reducing much better. Another point was when there's a lot of demand in a certain direction. So take, for example, there is NFP or London Open. Usually you tend to see this when you're trying, even when you're trying to attempt to trade news. When orders start coming in, you start seeing the spreads increasing. It's not because the broker is increasing the spreads, but it's a market phenomena where the order book, once you're an order flow trader, you understand that it's the orders in the market that there is so much demand in one direction that it's starting to create gaps in the market. So yeah, so that's the first bit. And then the other inference you can try to make from this simple illustration of what an order book is when it comes to price change. So you can tell, which I've already discussed, price changes more when the market is not able to absorb incoming orders at the current level, and less when the market is able to absorb incoming orders. So we've seen from the first example, the price shifted, the 60 contracts shifted the price to 1.5 because there were enough orders in the market to actually to make the price not go as much or far away from the previous price as possible. But then in the second example, when there were less orders on the order book, then you get to see that price went beyond 1.5. And it's a simple illustration, but it gets you going and understanding the background and all that. Yeah, so that's what you can conclude from knowing about spreads and knowing about price. And then the other one is, once price movements meet a large order block and all orders are absorbed, it ceases to move in that direction. So this is something you can see even in trends. And now you know what happens in the background and how the order book is behaving and how all this is playing out. So it shouldn't be something where you don't know what the market is doing. You just know it's there are indicators, there are bullish patterns and all that. But then now you get to think about the market from behind the scenes of what's really happening. And then the last point is price searches for liquidity. So from what you've seen, the previous example, this one, for 60 contracts, the price headed to a point where there was liquidity, a pocket of liquidity, which is now, liquidity is simply orders somewhere, sitting somewhere. So at the price of 1.5, there were 13 contracts, and price moved until there was enough liquidity, and then it stopped moving. Like, you can just infer that from a simple illustration you have. So those are the three inferences you can make from that. So now we're going to make it slightly more advanced. We're going to add a few more concepts. So as I said, order flow is a lot, and what you're going to cover in this section is also, we'll barely touch the surface, but at least it's going to help you understand how to view the markets. So we had assumed that, okay, from the previous illustrations, we've assumed that there are only limit orders and there was only one trader in the market. Okay, the simplification is so that you understand how these things work and how to they behave. So let's look at an example. Perhaps, or maybe you see something like this, a bullish engulfing pattern in the market. So if you're a price action trader, then you know how a price action trader is going to interpret this. They're going to say sellers are losing momentum, and then buyers are coming into the market and pushing the price higher, which is true. And then also there's a possible reversal. Perhaps you've seen this at the end of a downwards trend. A price action trader will say there's a possible reversal here. But then how do you interpret it from an order flow perspective? An order flow trader, or if you understand order flow and price dynamics, then you start trying to piece out everything, because everything is not so obvious. Or you can't just tell everything by just looking at a chart once you understand order flow. So the first thing is you start by finding out the level of market participation, and then you see the trading hours. So you're just trying to gauge, did this happen when the market was liquid or illiquid? And then if such a pattern occurs when there is low participation in the market, then the trader can conclude that the pattern formed due to low liquidity and not necessarily an influx of buyers. So you can see two different styles came to two different conclusions, simply because one had a greater understanding of how the markets work. So sometimes you can see a bullish engulfing and the pattern doesn't work out the way you wanted it to work out, and you start wondering why, and you just move to the next setup without knowing or understanding these things. So now you can see interpreting things from an order flow perspective, and you start understanding the nitty-gritties and to filter out the not so good trades with the good trades. Yeah. So yeah, those are the advantages. The order flow model allows you to understand why price behaves the way it does. And then chart patterns and technical indicators do not move prices. It's the interaction between buyers and sellers in the markets. And you can see this interaction and just try and imagine how the order book looks like. So order flow analysis is a detailed analytical approach to understanding complex interactions between market participants. It enables traders to find high precision trades. So with your knowledge of order flow, you're able to filter out signals that per se will not be ideal, and you wouldn't have seen them if you're, say, using technical analysis or price action analysis. And we'll build up this concept slowly as we go on. And then the other thing is with order flow is price action trading lags less than technical analysis, as it strips away of indicators that mostly lag. This is something most price action traders usually mention, and you'll hear this in forums and everywhere, which is true. When you remove the lagging indicators, then with price action, it's a bit more closer to where the action happened, and you're able to enter at a better price. But then when it comes to order flow trading, and specifically advanced order flow trading, you find that you're even able to trade without looking at charts, because you're able to understand how the market will behave, at specific price levels and all that, and you wouldn't even need charts to even trade. And then order flow trading has the lowest latency, because you're now able to see where orders are likely to come in and all that. And we'll go through this step by step and build something from that, build the concept slowly. Yeah, so the last example, so say from our previous model, there was trader G. He came in with 60 contracts. So say a different trader H could be coming to the market at the same time with a market sell order of 40 contracts. So you have trader G who had 60 contracts he was buying, and trader H who had 40 contracts he was selling. These are market orders. Okay, remember, market orders take precedence over pending orders and order book orders. So if someone comes in with a sell market order, it will be instantaneously matched with a buy market order. So when, say, trader H comes in, he consumes the 60 contracts. Sorry, the part of the 60 contracts, which is 40 contracts from trader G. So now it's only 20 orders that will be pegged to the order book, and of which now our dealer A is going to absorb those 20 orders. So in this case, once there are more participants, then price has changed less, and you're able to see this and visualize it. So this is quite a simple model. You're going to now try and make it slightly more advanced. And this is where you introduce the concept of liquidity distribution model. So now we have, we know we have different market participants, and let's try and categorize them based on the behavior. Then from there, we build a more comprehensive order book. So it's worth nothing in the real world. There are many players that affect liquidity. A more realistic snapshot of the order book will be to include the following. So the first one is market maker orders. So a market maker is simply someone who takes the counterparty of your trade. They ensure that every time you click buy or sell, someone is going to be on the other side taking that trade. So if you click buy on your MT4 or MT5, someone is going to sell you so that you buy. So one of the regulations, I think, in CMA was the broker is supposed to be non-dealing. There's this whole issue of dealing and non-dealing. So a dealing broker is one where he's the counterparty, or they are the counterparty of the trade. Then a non-dealing broker, they find different market makers. They find different dealers that are separate from the company that come and act as market makers. So number one is the market maker, and we have market maker orders. And then the second category of players are the guys who are putting pending orders. So perhaps you've done your analysis, your price action analysis or something, and you're saying at this price, I want to enter a trade. So it will go in form of a pending order to the order book, and the broker is able to see this in the background. And then part of the pending orders will be technical player orders. So these are guys who will distinguish this slightly, but they're still part of pending orders because these are guys who you can predict where the orders are. For example, if you look at a chart and you see there's a support or resistance line, obviously you can tell that there are guys who are analyzing and placing they're going to want to buy or place their orders around this level because some strategy says buy at support, sell at resistance, something like that. So these are players that tend to place their pending orders around specific price levels that you can easily even identify. Then the last party is latent interest. So these are participants who will trade if price moves to a particular level, but will not place pending orders because they do not want exposure. So the guys who know about even the order book, or maybe they don't, but say you're doing analysis and say the price is quite far away from your market, from your anticipated level, then you can be like, once the price comes close to my level, then that's when I'll place a pending order. Or once you start seeing certain signals, that's when you start placing a pending order. So that type of category is called latent interest. So now we need to understand how these players interact in the market for us to build a more effective order book. So this is just a snapshot. We're going to go back to this much later. So first you can see it's a bit wider. We've widened the whole table. So now you have your market makers, market maker ask and bid. These are now your dealers that the broker uses, and then they're pending orders. So this is when you say you place a buy limit order at some point, and then it's recorded on the order book. And then there are guys who place orders around certain levels. So say 1.4 in that market was a level, an important level for technical analysis. So you'll see a lot of pending orders around 1.4. So in this case, it's 40, then you have 18 and 30. So we're not going to use charts yet. We just want you to understand the price movements before we start making inferences and looking at trades and all that. Yeah, so, and then the last category is latent interest. So these ones won't be recorded in the order book because it's personal. If I'm intending to trade, there's no way the broker can know I'm intending to trade 90 contracts at 1.5. But we assume they're there because that's how the model works. And we'll explain further when we get to more advanced concepts. Then now, what you're supposed to know from here is how these players interact and how these interactions cause or affect prices. So that's the next thing you're going to look at. So there are few rules that the model provides, the liquidity distribution model. The first one is market maker orders will always remain constant regardless of what happens to price. So this is actually their job. Dealers are supposed to always give you a price. Even if the market is dropping in what manner. They're supposed to give you a price, and they're called market makers. Their work is to make money from spreads, not to make money from trading. So they're always going to be there, and so hence in the model you can assume the level of market orders from market makers are always going to be the same. Sorry, the level of orders, pending orders from market makers will always be the same. Then the second one is latent interest will convert to pending interest as price comes closer, then eventually market orders. So this one I've already explained extensively. Once, if I'm intending to trade something, I need to wait for signal. Then once I start seeing price coming to my area, say 2 days or 3 days from now, that's when now I'll start thinking about trading or even placing pending orders. So when price approaches a certain level, then you start seeing latent interest now converting to pending orders. Then you start seeing pending orders in the order book. And then pending orders will convert to latent interest as price moves from that level. So if, say, you had placed a buy limit order at some point in your chart and price moves, it doesn't touch that price, it doesn't touch your order, it moves away from that order. The natural thing to do is to just close that order and analyze again. So that's the behavior you're saying, and you're trying to put it in a rule. Pending orders will convert to latent interest as price moves away. And then technical play orders will remain fairly constant around price levels. So just remember, you're building these rules so that you're able to now understand when you look at interactions on the order book, how those interactions come about. We need a set of rules to guide us. So these ones you don't have to cram, you just need to know which party is which party and maybe where you belong and all that. And then now the latent interest will shift along depending on the perception of the true value of the asset, which again is, if I'm analyzing something, then when I believe it's supposed to be a buy, and that's when now I can intend or show that I'm a latent interest participant. Yeah, so now let's try and do the same thing we did with Trader G, but now from a slightly more advanced perspective. So it will be extremely complicated to try and detail the thousands of participants trading the markets for different reasons, but we can build an understanding of how price behaves using a simplified liquidity distribution model. So that's what you're going to do. You're going to look at the same table you looked at, but now slightly different. And you're able to understand how price is behaving. Again, when you're doing order flow, many people will expect charts, but charts are the last thing you're going to do in order flow. And a proper order flow course will probably take you 6-7 months just to understand how price moves. So even after you're through with this webinar, just know that I'll give you certain topics to research on so that you understand exactly how price behaves. So yeah, let's rerun Trader G, the market order you had, but this time with 47 contracts. And then we see how this will look like on the liquidity distribution model that we just talked about. So remember, there is the market bid, there is the market maker orders, the pending orders. In this case, it's 5. And then now there's pending orders from us, normal traders. And these are they recorded in the order book. So normally they reduce, remember the rules, the pending orders convert to latent interest when price is far away. So you see here, there is more latent interest than pending orders. And then here there is less latent interest and more pending orders. Because at this level, probably there are guys who already put in pending orders and they'd want to participate in the market just in case the market moves to that direction. And then the same thing with this side. So we're going to analyze a buy situation. So that's why I've just kept majority from ask, like from 1 going up to 1.5, 1.005. And then this is the price. Yeah. So, okay, this shouldn't be quite strange because when you open your MT5 or MT4, there's a section where you can click and just see, is it market depth? Something like that. But it will show you price in form of a ladder, which is basically what you're trying to build here. So yeah, so assume, let's make those, So assume, we said Trader G is coming with 47 contracts. So from the liquidity distribution model, there are 5 contracts offered at the market order with the market makers at the price of 1. So basically the trader came, opened his MT4, and he was seeing the blue price, the ask is 1. And then there were 10 orders that were pending. So there were traders that had kept 10 pending orders or limit orders at that point. So the first 15, so you know that this is a total of 15. So the first 15 contracts of G out of the 47 orders will be consumed at that price. Yeah. So yeah, at that price level. So the current price here, these entire orders here will be consumed. Again, you're still assuming that there's only one market player in the market, so that we are able to simplify things a bit. And assume that the technical analysts determine that 1.3 is a resistance zone. Yeah, so TPO, technical analysts orders, pending orders. So say this is a zone where in the chart, if you analyze, you see that it's a good resistance. So a lot of traders expect to have some limit orders there. So yeah, so the first thing is now you're trying to build up instances, or you're trying to break down how that order will be processed on the order book, assuming trader G came into the market. So those are 47 contracts. 15 of them have already been consumed at a price of 1. And then at 1.001, this price, the order book shows that there are 9 pending orders. Yeah. And 1 latent interest orders. And then at 1.2, you have 8 pending orders and 3 latent interest orders. Recall that latent interest is a desire to trade. A trader will have to manually, sorry, this is a trader. A trader will have to manually place a market order. This takes time to complete. So the order will, okay, the slides, we've just prepared them in the morning, so there are some typos here and there. So G will only be filled with pending orders, which makes sense. If I'm a latent interest player and I'm intending to make a pending order, obviously I'll have to do that manually. But then when you click buy on the market, say for trader G, that order is processed instantaneously, meaning these latent guys won't be able to convert in time for them to be pending orders, because this is in milliseconds. So what you're going to see is that it's only these pending orders, these ones for pending orders and TPO, that are going to be consumed whenever there's a large market order, because there's not enough time for someone to convert from latent interest now to a pending order in the market. So the result is G's order there will be 9 contracts to fill at 1.1, 8 at 1.2, etc, etc. Yeah, so which means that the remainder of the orders, considering that there were 15 orders that were absorbed in the first instance, the remaining from the 47, which is 32, will be absorbed here, here, and here. So yeah, so that's how the market will look like. Yeah, so from 9, 8, 7, and 8. So these ones, when you add them, I think they're 32. And that's how the rest of G's orders were consumed. So the market, after G has placed the order, like a few seconds, minutes after G has processed his orders, will look like this. So notice how the current price has shifted from 1.004, or has shifted to 1.004 and 1.003. Yeah, so when G placed the order, it consumed liquidity, and then once his order was processed, then we now end up at a new level where the price is currently at. So now the new ask and the bid will be 1.004 and 1.003. And then recall that this is an order that has been processed in milliseconds, and then the only participants who have had time to react are market makers. Because I'm in the business of spreads, then I should have algorithms that usually follow the price quite closely, although there's usually still some latency. So also notice that some pending orders at 0.9 and 0.99 and 0.998 have been converted to latent interest. So for these traders here who are looking to sell the market, because price has moved to 1.4 and 1.3, then now they'll remove their pending orders and stay on the side, which now they become latent interest. And then other participants at 1.04 and 1.05 have now converted from latent interest to pending orders. So these guys here, initially there were 6 latent interest orders, 5, but now they've converted, and you see the pending orders have increased from 5 to 8, from 5 to 8, and this one at 1.4, it was initially 6, now it's 10, because guys have converted and are now intending to trade. So this is basically a snapshot of how it looked like. And then now for the market makers, since they're able to use algorithms to follow these prices closely, then there will still be 5, there'll be new pending orders at around that price there. So Yeah, now this is where things get interesting. Yeah. You will notice that in those few seconds after that price, or minutes after that order has been executed, there's usually a large gap. So between 1 to 1.3, between 0.9 to 1.3, there's literally very few. Okay, in a realistic perspective, there'll be very few orders here. Okay, so in advanced order flow classes, you will learn that price has a higher likelihood of changing to the direction of lower liquidity, as it is easy to consume pending contracts. So if I'm a trader in the market, say I'm a bank, and I'm able to see this, and I can see that from 1.3 to 1, there's very few. I only need 5 contracts to push the prices back down to 0.9. Then I can know that I have a good risk reward ratio. First off, there are a lot of pending orders above 1.4. So this is 10 and 8. And so price is more likely to move down and to go up. So this is why you usually have instances where you'll see a market moving, say, in one direction instantaneously, a parabolic move, that's what it's called, a parabolic move to a resistance. And then after a few seconds, it comes back down. Actually, I think there's an example here. Yeah. So you'll see market moving so fast to this level, and then it covers, because the liquidity here is very small, and it takes very little effort for a guy with deep pockets to move this thing back to where it was initially. So from here, if there are any questions, kindly post them on the chat, but we'll stop at this point for now, so that we are able to just consume or to synthesize what we've just learned. But there's a lot we can do in this area of order flow. And then another thing is Dennis is going to come in just to give a few examples, so that you can familiarize with exactly how this maps out to the charts, because order flow can be a lot of theory, and then you need someone to show you how to apply it practically. But other topics in order flow include stop hunting. I know this one, there are a couple of guys on YouTube that talk about stop hunting, and then stop cascades. You understand what stop cascades are, and volatility, episodic volatility, option barriers, and even macro trading. So once you're an order flow trader, you're able to easily understand how prices will behave, so that you're able to take advantage of macro movements, or even times when there's news, because you can reverse engineer the order book and just see exactly where you can place or you can position yourself to better take advantage of whatever is happening in the market. So at this point, I think I'll give it back to Dennis to just show a few examples. And then from there, I think we can conclude the session. Dennis?
Okay, thank you, Sam, for that detailed presentation. I think you need to allow me to share my screen from your end. Thank you. Okay, so guys, I know that was a lot to take in, but we are going to see how this basically plays out from the perspective of charts, simply looking at a basic price chart. So there's a couple of things that Sam talked about. Due to time, I'm not going to go into a lot of examples, just one to give you guys a starting point. And from that perspective of technical analysis, because that is what most traders are usually exposed to, especially at the retail level once you guys start trading. Now, simple price chart, for example, this we have here, Euro USD, and Sam talked about price change and absorption of orders. So typically, price usually moves from a point of balance to a point of imbalance. Now, that point of imbalance, that is where you can see the change happening. And that point of absorption, that's usually the point of balance. So now, and these points of balance is where you also tend to see large order blocks. Now, which points are these on a typical price chart if you look at the price chart as it is right now? So swing points. So usually you've had, for example, in an uptrend, you have a series of basically swing highs. That is higher highs, this high, that high, and this high. So series of basically higher highs and higher lows. So you have this low here, that low here, and this low here. So you are looking at those swing points as areas where you will have an absorption happening or an order block, which as I've called a point of balance. For instance, here at 120 here, this swing low, that's a point of balance. Then price shifting and moving, that's a point of imbalance. Okay. And again, you'll have another point of balance, then imbalance, then balance, then imbalance. So typically these moves here, that is where, you know, money is being made. And, you know, traders usually want to take market participants, that is, they want to take advantage of those particular moves. So points of balance basically are points also whereby traders agree or market participants agree on value, but of course they don't agree on price. That is why basically price has hit that pocket of liquidity and halted its upward movement. So market participants usually find areas where they agree on value. Always there's an area where they agree on value and there are areas where they don't agree on value, but always market participants agree on value but disagree on price. Okay, that is why you have those movements. So a simple way of putting this, using a technical tool of even spotting those swings and where price will potentially move. Open your platform. As you can see, I have mine here. This is a MT5 platform. Come to your indicators and I can press Control N, and then there are indicators which were developed by a trader called Bill Williams. And specifically, the one that you want to focus on is fractals. Can open it up, fractals, and okay. So when you look at that chart right now, so this is a price-based indicator. You can see it's not even below the chart. It's not like a moving average, typically will be. So those swing points that you're seeing, okay, those fractal areas, those points called the fractals. Okay, and fractals tend to repeat themselves even at the micro level. And for those guys who have come across Fibonacci behavior and Fibonacci as a trading tool, they understand that. Now, this typical chart here, those fractal areas, that is where we have those order blocks. Okay, and this is on a daily time frame chart. You can even see them on a H4 chart, for instance. Now, assuming you are a trader, you want to go long, for instance, one of the cardinal principles in trading is that the trend is the basis of all profits. So using those swing points, you have basically identified the trend. For instance, let's look at this trend here. You can even look at this one, current one. So typically, what is a downtrend and how does a downtrend, what are the characteristics of a downtrend? So a downtrend tends to have lower highs, a series of lower highs, that is lower swing highs. So you have this one here, this high here, then you can see this next high here is lower than the previous high. Okay, so the assumption is that we are in a typical downtrend. So typical common sense, if you want to buy a particular asset or anything out there in a market, and you would want to buy it at a selling price, and the selling price, that is the ask price, is usually higher than the bid price. So the next swing high, this is where the order flow trader will tend to want to focus on. And as I said, if you break down your chart, you will see all those points there. So points of balance, for instance, that swing point, price comes this lower at this swing low here, rallies up to this particular point here. Then you have a point of balance where traders agree on value. And then you have a point of imbalance. Okay, so typically these prices are being pushed down by guys who basically started trading at this particular point, that point of balance. That is where they're trying to look for a good price and then selling off that particular asset instrument. So what you guys can do when you're checking out your charts, just activate the fractal indicator, and you can even look at it at a micro level. Like let's say, for instance, today. And some also talked about those particular behaviors happening at particular intervals of time. Like let's say, for example, the London Open. You can see right now it's a minute to the New York Open. And this high here today, for instance, this high that you can see here, at what time was it printed? So we had an order block there at, I'm trying to locate my crosshair here so that I can, yeah, insert it. You can see, for instance, at 10 exactly, we had an order block here and price rallied lower. Moved lower. So that was a point of balance at around 195. Then price shifted lower, found balance again here, and then moved higher. So basically, as Sam was saying, it's very important to know, even if you understand that, okay, this is a swing point level of support and resistance, what is happening behind the scenes? Why are traders considering that point as a swing high, as a swing low? And these are the points which Sam talked about when he was talking about order blocks and areas where there is a movement, because no one is interested in price at that particular area. It's no longer a value area, and so we'll tend to see an imbalance happening. And so that is basically where a downtrend from this order block here to this point of imbalance, and then we have a downtrend triggered. So due to time, I'll stop at that particular point, but guys, feel free to reach out. And there is a lot of resources also out there on this. You can check them out on YouTube. And you can be able to apply this from a technical analysis perspective, even when you're drawing your trend lines, when you're drawing your support and resistance level. They're just not levels or lines that you stick on your chart, but you understand the dynamics and the mechanics behind them. So I don't think there is any question, Sam, but guys, feel free. You can shoot an email asking any questions and more follow-up. So thank you guys, and have a nice weekend.